what's happening and, how we can have a clearer vision and navigate through the noise of, what's going on in our market and how we can serve our constituents, our clients, better by having better knowledge. Okay. Let me just pull up my sheet here. Hang on. And does anybody ever feel like sometimes we're too close to what's going on that we maybe don't see the forest through the trees? Like, you hear one report today, one report tomorrow. I think a perfect example is Dan. Rates are going up 3/8 today. Rates are going down 1/4 tomorrow. It's like a yo-yo, right? Where's everything going to land? And the real estate market, I don't think. Well, I know it's not as irrational in terms of day-to-day pricing, but it is more trend driven. And if you listen to Jeff Otto, who's like the New Jersey real estate economist, he does probably the closest thing to the new NJ Schiller report. And he was talking a bit about what was happening in our local market. I was not able to attend, but I've been debriefed by some of our leadership team, and I want to share with you some target markets that I just took a look at, and I want to show you what is like history and what is future. So the history is the stuff that's closed, which tends to be like a month behind. And let me just see if I can get this full screen. All right, can you guys see this all right?
Yes.
Okay, so this is like our largest MLS that we have in terms of participation, called the Garden State MLS. It's going to be a benchmark for other ones. Some of them are different, but most of them in New Jersey are behaving similarly. The only exception I did notice is Hudson County tends to be behaving significantly differently than the rest of the MLSs that we have that kind of cover, Bergen County through all the counties that are surrounding New York City, the greater Middlesex County, and Monmouth Ocean. Those counties are behaving very similar in terms of correlation. Hudson County, I think, must be trending more like the New York City market. Let me just log back in here. So this is historical. This is closed data from August of 22, and it's comparing it to the prior month. And it's saying that the percentage of property sold at 100% or more was down by 5%. That doesn't seem to be a dramatic number. Probably was somewhere in the 40% range that sold over 100%. Maybe it went down to 35%. The average sale to ask ratio, if it was trending at 103, now is down 1.25%, which is pretty significant. The number of units sold is actually increased. Okay, that seems to be a little bit counterintuitive. The value of the home sold has also increased, but not increased by the number of units sold, because we've seen a modest price decline of 2.3%. And the number sold is see the total value of sold up by 4%. The number sold was up by less than 0.5%. I misspoke earlier. So those numbers to me, aren't tremendously alarming. I think they're encouraging. However, I do think those numbers that closed in August were May, June, July contracts. And I wanted to look to be a little bit more relevant to what's happening. To get more relevant, what data you think would be more helpful for us? Anybody want to chime in?
Price reductions?
I mean, price reductions are relevant to see. How about
under contract last 30?
Under contract.
Under contract.
Yeah, so those who said under contract, that's what I spent about 40 minutes this morning trying to figure out some markets, and I wanted to share with you what's happening in the under contract world. And I took in, and I apologize to our Bergen, our Monmouth team, and our partners down in Florida. I am just not as proficient at using those MLSs, so I keep defaulting back to my comfort zone. I took Randolph and Morristown, which is a suburban part of Morris County and a more urban area. I took Maplewood and Montclair, where we have offices in Essex. And then in Union, I took Linden and Union, which tend to be, you know, a lot less, you know, they tend to be blue collar, meat and bones, you know, consistent markets. And I wanted to share with you how those are behaving. And I still think that those are behaving more based upon the inventory that's available instead of, you know, people holding back. Okay, if we look at September of 22 versus September of 21, would you agree that September of 21 was probably one of the high points of the market, right? The market continued to go up. Everything was great. We didn't have any talk of massive inflation. We had, you know, record low interest rates. In Randolph, New Jersey, we had 61 under contracts in September of 21, and September of 22, we had the exact same number. Morristown had a 10-unit drop. Maplewood had a 2-unit drop. Montclair increased by 2 units in September of this year versus last year. Linden dropped by 11 units, and Union Township increased by 17 units. So we went from 442 to 438. It's statistically insignificant. And the prices from a year ago to now are still significantly higher. So the total volume in these 6 selected markets is actually up in terms of properties going under contract. Now, if you were to, you know, watch the media and listen to all the pundits, would anybody lead you to draw these conclusions?
No.
Hello? No, right? I mean, you know,
No.
everybody's trying to have a headline and sell the sizzle, but these are numbers from our MLS, and it's not, you know, it's not like anomaly numbers. Randolph was 63, 74, 75, 68, and 65. I mean, these are all, you know, pretty tightly range bound. I don't want to be tone deaf to what's happening in the market because, you know, Robert Garber, are you on? I can't see everybody here.
Yes, I am.
So you want to just repeat what you shared with me about, you know, how the changes in mortgage rates impact affordability, and give everybody like a long look at, you know, what that impact is going to be once some of the inventory clears?
So the information that Rob's referring to is what I gathered from the auto seminar yesterday afternoon, and he's a proponent of the fact that for each point that mortgage rates rise, it takes away 9% of a buyer's purchasing power. So you can imagine since last year to now, you know, if we're in the mid 6s now, and a year ago we were in the mid 2s, that's 4 points. So that's 36% of the buying power of a buyer is gone now in terms of affordability. So we have to be cognizant of that. What he did say too, while we see that overall housing sales numbers are down, inventory is, you know, starting to climb a bit. Many buyers, or some buyers, have moved to the sidelines because they are under the perception that the interest rates are going to come down, you know, in a couple of months, and it would be a better time to buy then. In fact, according to Jeff Otto, he doesn't expect interest rates to really start coming down in any meaningful manner until maybe 2024. So he also took a look at a 50-year average of home values in New Jersey. And for over 50 years now, home values in New Jersey have increased each year at a 5.4% increase. And he did it for 20 years also, and he saw that the same thing, 5.4% increase. So that while he believes that this in 2023 and 2024, there will be a return more to normalcy in the market, and that the high prices that were achieved during the past 2.5 years is not sustainable. And he believes that 2023, 2024, we're going to see about a 5% in home values each year. So even that, given that, we had a run-up of 33% in home values over the last 2.5 years, so that if it's 10% that we lose over the next 2 years, someone buying a home, unless they're planning on selling it in a year, buying a home is still a smart thing to do. The average lifespan of owning a home in New Jersey that you purchase is 10 years. So if you're buying a house and you're going to stay there for 10 years, there's still reason to believe that there's an upside to this transaction, with certainly, even if you're going to pay at a higher interest rate now, you'll certainly have time in 2023 or more probably 2024 to refinance. And then you will also be in a position to building equity in your home over that time, and then get it down to a more affordable interest rate. So that the story for buyers is, it's still an optimistic one, but they have to be realistic. And the same thing with sellers. Sellers have to understand that we are anticipating this decrease in home values, so that when we price properties, they can't be thinking about the fact that their neighbor down the street, sold their house, for so much more, a year ago. I mean, that's not the market anymore. And it's our job to explain to them how the market has changed and where we think it's going to go, and why it's still a good time to be conducting real estate business. So that, in the Reader's Digest version of the seminar yesterday, while there was, a lot of information that, you could come away from feeling, oh my God, the next 2 years in real estate is going to be really difficult. But it's really, and Nick Bailey also referred to this as normalizing markets. We're going to get back to realtors being able to really do their job and really work with buyers and sellers to explain what's going on in a more normalized fashion. And that those who put the time and the effort in are going to be successful and continue to do business even through the next couple of years, which will be trying.
So hopefully that gives us some insight. And by no means am I saying that, hey, don't be very aware. I think the margin of error is shrinking. There was an old saying, like, God, give me one more good market. I promise I won't blow it this time. We're not in a bad market. We're in I think, a more normalized market. And I think if we continue to, focus on the fundamentals, we continue to share information that is not being shared with our buyers and sellers, that we're going to be, in a better position relative to the rest of the market. And, I'm going to say that virtually every one of us that's on this call today is a career person. We're not a the market's hot, let's get a real estate license person. And I think that's a huge difference because, you know, those of us, and I'm going to repeat what we talk about a lot of times, those of us who've been in the business many years, it doesn't really matter what the market does. You know, we're just continuing to do the fundamentals and go through the market. And, you know, if you have a good business plan, there's no reason why your business isn't going to grow. And if your business grows in the smaller market, your market share is going to grow at an exponential rate. Does that make sense to everybody? Yes, no, we got some sleepers on the call.
Yes, it
Yeah.
does.
It does.
So,
Yes, it does.
you know, I would say that, you know, the market's not 2008 range. There's still, tremendous demand. I think Jeff talked about that there is demand, and the accelerator on the demand is going to be the affordability component, right? And go ahead,
Yeah,
Robert.
just to touch on that, the one thing that you just mentioned there too, he also talked about how he does not foresee the big foreclosure problem that we had back in 2008. So that he doesn't see, you know, a flood of foreclosure properties coming onto the market.
I
So,
agree with that in Florida. We still have a shortage of inventory down here. And now we'll probably have even more because of the catastrophe on the West Coast. Rentals will be gobbled up, and our market is going to change drastically. I'm, you know, down here a long time. After Andrew, we experienced a huge real estate boom. It's not, you know, happiness that makes me say that. It was just reality because people had to have someplace to live. And the builders couldn't build and repair things quick enough.
and Colleen, this was a 500-year storm, right?
Yes.
So,
I've been here a long time. This is the worst I've ever seen. And I think it's going to impact us a lot more because of the value of the properties that were destroyed. I think the insurance industry, they're saying that our premiums down here will very possibly double. I'm paying $7,000 a year on my house.
We will bankrupt certain insurance industries because a lot of homes in Sanibel, that whole entire area, were secondary homes. So them being secondary homes to the Midwesterners and Northeasterners, you're going to find ourselves in a deficit, and then two, as you saw, the rentals. We already have an influx of people looking for places, as I've been going through this and trying to find them Airbnbs just for them to stay, because there is no electricity or anything there. You're going to see a shift in the market in this area for sure.
you know, and I think, you know, we just have to be aware of that and try to, you know, help, you know, help those that are, you know, in this, you know, predicament and, you know, not exploit the situation. You know, I mean, there probably is, you know, a segment of the population that's going to say, oh my God, there's all these people, I'm going to triple my rate. And I think that we need to be, you know, conscious of the sustainability of the actions that we take.
Actually, after Andrew, people were giving rentals for free. I mean, and after the other hurricanes, it's a different mentality here. When you have a catastrophe like this, people generally become more benevolent. Developers that have a lot of units that aren't rented out yet will be giving those at half price. I don't think we're going to see a lot of gouging here. First of all, it's against the law. We have a law in effect that if you gouge, there's huge repercussions from it. So I'm looking for a lot of people, you know, being true to their nature, being good people.
Right. And Colleen, go ahead. Sorry to interrupt. Go ahead.
I was just going to say, I think that the difference now also, Colleen, is that, people are using the Airbnbs and VRBOs as their businesses, right? So, that maybe wasn't the case as much back when Andrew, so I mean,
Yeah.
and I'm not saying people are going to be, okay to gouge, but I think it's just sustainability on their businesses, is going to be reliant on hitting certain numbers, and I think that's
Yeah.
where,
Oh, no.
and that's where it's just, I'm an Airbnb owner as well. And it's, I mean, I feel horribly for a lot of the people, but it's also like, I can't also lose my house, as well, so I think that's the other component of it that's a little bit different, is that it's not only the good of people's heart, it's also, they have to keep their numbers where they are, you know what I mean? So, and I agree. I think that, there is going to be the potential for what Rob said, for people to, raise their rates and whatever, just to capitalize on this situation. And that's going to, that's kind of like, I think karma's a, right, when that happens.
Mhm.
So I think that, it goes back to the decency of everybody in doing what's right, but also, sustaining if they can sustain what they have, if it hasn't been wiped out,
Exactly.
Sorry for jumping in there.
No.
I mean, not only is it bad policy, but it's not even a legal practice. So, for Colleen and our team down there, I know none of us would do that, but we have to be careful of, being affiliated with clients that, try to take that path. And we need to advise them, and if they're looking to do things that would be inconsistent with our values and with the law, we need to walk away from business like that.
Absolutely.
In terms of, like the numbers that I shared, the sales numbers, compared to the prior month are, the closed businesses overall slightly higher. The sales price is very mildly, adjusted down, I mean, by like a fraction of percentages. And it looks like the new under contracts, as far as I can tell, is more a function of properties that are available than, buyer demand or buyer withdrawal from the market. Would anybody want to comment, either in agreement or, saying that they're seeing anything else in the front line?
Well, in Florida, we're seeing about the same thing. I checked the numbers while you were talking. And we're just off very slightly what we were last month. And last month was a pretty good month for us. Again, I think it's supply and demand. We probably have a little more supply than we've had before, but not a lot. I think for the month, there's 100 more condos and 26 more single family homes than we had before. But that's, that's not huge.
We're seeing
considering the
prices come
numbers.
down too also.
Yeah, a
So
lot
a
of
lot-
price reductions.
So,
Oh,
so,
yeah, a lot of them.
so Colleen, what happened now, when you're in, did Andrew hit Miami hardest? Where did Andrew come in?
Andrew came
Homestead.
into,
Homestead.
Homestead. It leveled it.
It
And,
wiped out the complete city, yeah.
Yeah.
So what happens to, the real estate market around the areas where you've had devastation?
So one or
Yeah,
two things
it has a
happened,
hard
right?
time go ahead, Paz.
No, go ahead, Colleen. Go ahead.
It takes some time for it to come back. Those companies are going to be really hurting. It's the real estate companies, and the realtors. It's going to be a very difficult time for them.
It took
A
10 years
lot
to
of them
rebuild Homestead.
Yeah,
10
a
years.
lot of them will drift over here to stay alive. I mean, to keep business. You know what I'm saying? They'll
Right.
have to work different areas because what they were used to working is just not there. I mean, if you don't have anything to sell,
But
rent.
then for companies like
Mhm.
your husband, remember he was a builder and it just did an
Yeah.
influx to the Coral Springs. That's how Parkland was born. Parkland was born
Exactly.
from Andrew.
And Weston sold out also at that time.
Yep.
Yeah, we did a lot of rentals back then too. A lot of people looking for rentals coming up our way. Because we got it, but we didn't, in Fort Lauderdale, we got it, but it wasn't as bad as Miami and Homestead area. But we did help out a lot of people.
Basically, the migration from Dade County to Broward really happened during that time.
Exactly. I don't know if we'll have migration from the West Coast, but I would assume a lot of those people will be wanting to go back, you know, to rebuild. And then there's a lot of, you have to remember, we have influx of people from up north. And those people from up north may not want to go back to the West Coast. They've never,
Yeah.
they've never experienced this.
I mean,
Our season starts now.
So Ron, how or Colleen or Fazia, how does the like the Florida Association of Realtors and the local boards try to, help with resolving this? Because, I think Dan mentioned that, we all have a business, and the people that have been affected, most severely, might have lost their homes, or the business is just not there, and they have families that they need to support. And I would say, by and large, like that statistic where, most people, would have trouble with a, $1,000 unexpected bill, that the real estate community, the rank and file of it is probably not exempted from those statistics. And, we need to balance, providing housing. We need to balance, having the systems to help our, our fellow, members of the, NAR, Florida Association of Realtors. Is there somebody that is, or which entity is going to be kind of spearheading, that effort from the past, tragedies?
Well,
of
it'll
course, it's
be-
always the state. The state board always leads first, right? And then your local MLS will then follow whatever state mandates and says. I think, Rob, the interesting part that you said, and the purpose of the call, if you had ran these numbers on Wednesday, let's say hypothetically you ran them Wednesday or Thursday in preparation for this call on Friday, you would have found on the MLS the fastest growing cities and the most homes sold were in the areas that just got wiped out completely.
Yeah.
Lee County and Volusia County, all those counties were the top 3 selling areas outside of Port St. Lucie, Martin County, were the top homes sold year to date. If you ran that
It's
report
Fort
on
Myers,
Thursday,
yeah.
it would have shown that. You run it today, something completely different.
One other thing with that I heard, guys, is I don't know much about the insurance over there, but I heard that it's more of it's not as common as some of the other areas in the country with the insurance and how it works, because some of the big name companies I'd heard are not as invested in there as they were, or they pulled out previously. So, I had heard that there could be some concern with the sustainability of the payouts on that. Is there anyone who can, touch on that? Just, I know it may not be
So,
part of what we're doing. I was just curious about that.
Yesterday, we actually spoke to our main insurance carrier about this exact thing. And after the last 2 major hurricanes that Florida had, there's going to be a tax that's going to go on all of our bills that probably we've never noticed before. But they're going to basically assess every single homeowner, whether it be $5, $15, to kind of replenish the millions or billion that they have to pay out for hurricane damage. So that's something that's definitely going to happen. Plus, we've had 17 insurance companies already bail out of Florida because they were expecting a storm. Citizens right now has been, which is, for those that don't know, Citizens is our state of Florida insurer. It is basically the state insurance company. And that is where most of our clients have had to get insurance this past year because of so many other companies that not only backed out, but if the electrical box didn't pass or the age of the roof wasn't 5 years or newer. A lot of these companies have put such restrictions on Florida because they didn't want to pay out in case of a claim. So
Right.
we've got a huge percentage that is with the state insurance company, and it's only going to get worse going forward. For example, in the Keys, because of the flooding and the storm surges in the Keys, they actually, a lot of those people don't have insurance or self-insured. And that's common practice. If you have a house in anywhere south of Homestead in the Keys, where the insurance premiums are so much money that the people literally don't have insurance, they self-insure themselves. And I think over the next 5 to 10 years, that's going to become more of a normal practice for a lot of these oceanfront or waterfront homes with the unknown of water levels rising.
Thank you.
Yep.
So anybody have any feedback on, recent listings and what the activity is on stuff that's been introduced to the market in the past 2 weeks from September 15th on? How are you seeing that compared to your expectations?
So far, so good, Rob. I think I told you at the beginning of the week, we're seeing a 10%, or at least I'm seeing a 10% price reduction from the peak 3 months ago. Those were the extreme high prices. I have 2 listings that just went live this Monday before the storm. Both of them already have offers. Both of them I listed the highest prices of the community based on what's been sold or relative to it, but not extreme. I didn't go for that, $50,000 over amount. And in both cases, I've had a good amount of viewings, especially considering that we had the storm this week. And both of them already have offers. And I have open houses planned this weekend for each, one Saturday, one Sunday. But we're already list price with multiple offers.
So what is, if you're not in a flood zone, and this is any of our Florida team, if you're not in a flood zone, you have a 4-bedroom, 3-bath, $600,000 home. What's the insurance on something like that?
So for let's just say a $600,000 single family home in the west suburbs, you're looking at about $3,700 a year right now, not in a flood zone, is about the average amount. And even if it was like a little townhouse, they're getting close to like $2,900, $3,000 for a townhouse. So if you've got a bigger home or closer to water, it could be in the 4s already. And if you're something out east, closer to US 1 or A1A, you can be 7 to 10,000 for something closer to the water a year.
And that would not even be in a flood zone, or that
Correct.
would be?
No, would not.
It wouldn't be.
So you could have
That's-
10 grand. So that's basically like an extra insurance, an extra property tax.
Yeah,
And it's so
Huge.
significant.
not
And,
including property
And it
taxes.
depends if they
higher.
have hurricane shutters, how old the roof is. There's so many variables.
Correct.
Now, that same, $600,000 house here in New Jersey, I'm going to guess would be closer to 2,000. And it obviously depends upon your coverages, but, Glenn, I'm looking at Anthony, what would you think a $600,000, house would be, in our primary markets?
I think 2,500 is about average.
Anybody else have any comments on that?
Hey, Rob, this is Glenn Jager. I met you at Plantation a couple weeks ago.
Yes. Nice to meet
And
you. Nice.
I live on the East Coast in Pompano Beach here in a condo.
And we lost your voice there, Glenn.
Glenn?
Did I? All right, I guess we lost him.
Trying to forecast what's going on, and we're suggested that it's going to be at least 180,000 just for the building. Each individual unit then has their own policy for contents liabilities. It's called HO6. I don't know if that's a universal term, but it certainly is down here. And a lot of people that are moving into the building can't even get insurance because of the bailout of all the insurance carriers here.
So it's getting to a crisis standard then, huh, Glenn?
Yeah, what I'm doing is I'm gonna have to raise our HOA rates about $50 just to cover that. And we're in the middle of our 50-year inspection here, which with SB 4D coming through by 2024 is going to have an assessment here of about $10,000 a unit for our 61-unit building.
What's I assume SB4D is relative to the Sunrise, the
Surfside. Yeah, it's the
Surfside
Surfside,
collapse.
yeah. They're calling it the Surfside bill, and there's a lot of modifications that are coming in that the governor's already signed, but they're not all in yet, and there's a lot of controversy over some of the terms that need to be shored up. So it's to be determined, and there's a lot of requirements. All of a sudden, buildings that were supposed to be the 40-year inspection are now accelerated to 35 years. You have to do a phase one with a licensed engineer, and there's a lot of documentation that goes on. But what they forget is that you can't get everything done in the unrealistic timeframes that are being there because you can't get a contractor or an engineer.
Right.
That's a great point too, is going to be the availability of contractors, like somebody was mentioning before. I mean, they can't build them as quickly as they need them. So I know, again, not trying to capitalize on different types of people, but I know some builders that have actually, established, down in South Jersey, when they had the storms, when they had Sandy and Irene, and not to gouge people, but just to help, and they know that the insurance money is going to be there too. So I wouldn't be surprised if you see more and more of that happening in the areas as well with some builders and developers, especially in those areas that Fazia was mentioning that are super hot. I mean, that's, obviously now they're destroyed, right? But I think that that's going to be a long-term play for a lot of people.
And you have a lot of major builders there, like Lennar is huge projects over there.
And Colleen, how bad was it in the center of the state?
The center of the state, not as bad, although Orlando did have significant flooding. Quite a bit.
It's
Right.
mostly the coastline, the west coastline. And then it crossed over and went to St. Augustine. And St. Augustine is one of the prettiest cities in Florida. And they got devastated with just a lot of water, storm surge. But the west coast of Florida got it bad. Fort Myers all the way up to Port Charlotte, I think it was. Not Port Charlotte. One of those little towns there that are by the water.
Well, Sanibel, Captiva.
Captiva.
I mean, they're not even accessible.
No. Infrastructure that was destroyed. The bridges, there's more bridges than just the Sanibel one. In Fort Myers, there were several bridges destroyed. So infrastructure wise, it's going to be very, very difficult.
Well, the thing is that our season starts now where all the tourists come down. So a lot of the tourists that go to Sanibel, Captiva, Fort Myers, Marco Island, they'll probably come here. So I think we're going to see an influx of business on our end, either selling some condos, houses, or doing a lot of rentals. So we're kind of anticipating that.
It's hard to imagine, looking at the, infrastructure that's no longer there. We have
It's
to, I mean,
it's so
I
much
think,
worse.
yeah, I think we have to
than
take a moment. I think we have to take a moment, Colleen, and reflect back and hope for the best with everybody. And then we need to move on to try to help serve the people that need us, because there's going to be a lot of people in need. There's going to be a lot of leadership that needs to be demonstrated by the real estate industry, even beyond brands. I know Fazia has opened up our offices for, anybody that's been displaced to, come work, to use it as a collection center. We're doing fundraising, but we all have to, continue to serve, because everybody still has needs that need to be met, and probably more significantly now than before.
Hey, Rob, are any of our lenders on? I do have a question to think about future. Or is anybody on, Bruce?
Bruce is not. Any other lenders still on with us here?
I'm still here.
Okay.
Oh, Dan, it's Fazio over in Florida. I do have a question thinking fast forward. Could you keep us abreast if you come across any news in regards to financing and things to that nature, because it will change. It will change the scope of how Floridians or anyone trying to buy here gets financed. And I know with the insurance issue and getting financed, that meets,
Absolutely.
And then I'm thinking, for all these homes and whatnot, you can't get a title, right? What are you, what are you basing it upon? It's a non-existent. If you could keep us posted on any of those new and anything to that nature on your side, that would be appreciated.
What I could do is I could look back and see what happened with Sandy with us here. I mean, it was rough, obviously, but you're going to see an influx of construction loans and stuff like that going forward. You know what I mean? Because the bottom line, there's going to be nothing to appraise, so that's for any loan, 9 times out of 10, you need the appraisal. So you're going to I heard, you're going to see builders come in and try to take what they can and do what they can and stuff like that. But for the regular person who needs the mortgage without an appraisal, that's going to be an issue moving forward. So I'm sure the state will have programs going forward, but let me look back just to see what it was like with Sandy. I know how bad that was and how long it took, but let me dig, and I could share with Rob.
Okay, I appreciate it. Thank you.
No problem.
Thank you.
All right.
Rob, I got a question. With the changing market, we talked about the under contract here in northern New Jersey. I noticed that you were talking about Linden and Union, and there was a huge disparity between Linden and Union in terms of units. And it seems like it just dropped off for Linden, which seems like in Union County, Linden may be the lower section of the socioeconomic status. I was just wondering, where do you feel like we should put auction style pricing with this? Do you still think that that's the way to go, auction style, and drive it up with the changing markets? Or do you think maybe there is a different recipe that we should be using?
Well, I think the fundamentals, remain true. And if you're in a softer market, right? And sorry about the background noise. If you're in a softer market, getting 2 or 3 bids is even more critical than getting, 14 bids in a strong market, right? So I don't think the fundamental practice is going to change in terms of how we're going to, coach our home sellers on introducing properties to the market. And, from all I can see, and I want your feedback because I'm not in the front line like everybody on this call. But I believe that the drop off in units is based upon inventory, not on demand. I think that we can clear more inventory if it came on the market at, reasonable prices. And to Rob Garver's point is, if the affordability is going down, that $1 million buyer is now a $700,000 buyer, right? From an affordability standpoint, presuming that people were maxed out. Now, there are still some people who might say, hey, I'm going to buy, I'm going to stretch a little bit. I'm going to hope that coin toss, heads I win, tails I win. If the interest rates continue to go up, which I think would create an unsustainable long-term marketplace. I think historically interest rates have to be probably in that, 5.5% to 6% range. And I think home inflation is over time going to be in that 4 to 5.5% range. Robert, did Otto comment on like a sustainable range?
So he actually said that he believes that rates are going to go over 7 and maybe to 8 before they come down.
Okay. So
one more
buying
thing I
now,
want to chime in. There's also, with how high rates have gone, there's also low to moderate income or low to moderate census tract opportunities out there. So their pricing comes in significantly less than what your regular borrowers are seeing. So for example, there's low to mod we're seeing still in the 4s. You know what I mean? So borrowers that are making your 60,000, your 80,000, stuff like that. I mean, look, Jersey's an expensive state. We all know that. But, you don't really need six figures to buy a house these days if you're in the right areas. Now, Anthony, you mentioned Union. I personally know Union well, and I know Union's had a lot of development. So seeing those numbers for that month in particular doesn't shock me, just because of some of the bigger corporate folks that are there and people moving and healthcare and all that stuff. So Union's been busy. And if you drive through Union, you sit through the traffic, you'd understand, why so much has gone on there.
And I want to just kind of piggyback on both of those comments, which is, let's talk about what the motivation of the Fed is in raising rates, because they're not out to harm the real estate industry. They're not out to cause problems. What they're doing is they're balancing the inflation problem with the interest rates, and they're controlling the amount of money that's going in the marketplace to try to put a lid on the I'm going to use the term unprecedented inflation, at least in modern times. And I think if you were to look at the overall population, inflation makes people uncomfortable, not knowing what something's going to cost when you go to do something, right? Going to buy a new appliance, to buy food, to go on a vacation. Inflation is not a positive to the economy long term. So the Fed's going to introduce some short-term pain to try to correct a long-term problem. But as we've seen over the years, all administrations have a motivation to see housing be healthy. And I don't want to misquote the number, but I think when a home trades or when a home sells, it like brings in an extra, $50,000 to $60,000 of economic activity to, painters, furniture, all the different things that people do when they purchase a new home. And that's good for the economy. If that dries up, that's going to be like a double punch to the economy in terms of, jobs, in terms of, even as cynical as somebody saying tax revenue, right? If there's not enough economic activity, the tax revenue goes down, and then the government gets concerned from a selfish standpoint, right? They need to have funds to run their business, which is, governance. So I think that, the authorities and the powers that we've elected, have a long-term bullish intent on housing and making housing affordable. I don't think that there's any politician who's going out there and saying, look, there's too much home ownership in this country. Does anybody think any politician has that motivation? I think, they don't want to see irresponsible home ownership that we've seen in the past. We've learned that lesson. But, home ownership is kind of a staple to the U.S. economy, that drives a lot of activity. So for those of us who are wondering, why is the government, penalizing us by, raising interest rates at a massive level? Think about it when you go to the grocery store, and you have to buy, goods and services that are, unprecedentedly affected by inflation. And the other piece is that the medicine might not even be the right formula, because this might be not wholly a demand. This might be more of a supply-driven inflation cycle, because there's not enough goods out there, and people now have some free cash that they're bidding them up. And if the supply chain that dreaded supply chain we talk about corrects itself, I think we'll see a lot of market forces correcting inflation. Has anybody tried to buy an appliance recently? I don't know what that looks like, but if that's still a nightmare, that's kind of the iconic problem that I see to our economy. Anybody, have a lead time to buy a new refrigerator or a range?
Yep, Robert just purchased one, and the original one that my wife originally wanted was, I believe they said a 3-month lead time. Now that would be fine if the condenser didn't go, right? So if it was a luxury purchase instead of a necessity, right, that would be fine. but that just comes into sacrificing some of the conveniences or whatever. I mean, I said, does it keep it cold? My wife's looking at all the other features and stuff, but I didn't know how many other features you could have on a refrigerator. So, I guess that's part of it too, is the, expectations for, delivery and performance in the, in the areas. And just one other note on it. I know we were talking the other day about one of our listings we had. We originally took it at, I think, just south of 6 million. And, I think part of this issue is also the education of sellers that are still in the mindset of the previous market, right? And they may hear this stuff, but it's like, that doesn't impact me. That doesn't impact me. My product's still good. And I think it's so important. I get a lot from these, so I'm very grateful also with the lenders and everyone kind of, filling me in on these things so I can help educate, our team and the clients. But I think that's a really telling thing, is that, now that property is down to, or that home is down to just under 3 million, right? Because the seller is well educated by our associate Fran, and kind of originally came in saying, I've spent so much money on this house, like I'm not going to lose it. Now they're looking at it and they're very well educated, and they're saying, this is what we need to adjust to, because the prime markets are going to get hit. I think in our area a little bit more than some of the other markets. So I think it's great. She tied them into, the loan officers, and they were able to talk to them and say, here's what's going on. And I think that's very useful tool to help get the people who are still in the mindset of the a year ago or 6 months ago market, and don't know the impact that the raising rates and all these other external factors have on their home values. So just wanted to touch on that. But it's hard to move a property from 6 million to 3 million without getting a seller to kill you.
I think in the higher price range that, where the markets are thinner, the adjustment in prices are going to be a lot more dramatic.
Yeah.
So if you're trading in that high price range, it's probably, and I know it's always, I'm like a broker market, it's always important to get the pricing right when you introduce it, but over in those areas, I think it's probably even more critical.
I agree. Totally agree. And again, the buyers and sellers, not to say anything, disparaging about anywhere else, but I mean, the buyers and sellers are very, very well educated in our markets. So fortunate, and a lot of them are in finance and bonds markets and banking. So they understand very well how these markets are impacted and affected. And if they find something, they know how to pivot quickly. However, that's not always the case for some of the people who may have been in their home for a significant period of time that are just relying on the media or news to supply them with their information, right? And then, they'll either panic and make irrational decisions, because they got to get their next house or whatever. And that's their prerogative. But the longer term play, I find, is that, by again, educating them like we're all trying to do on these calls and trying to navigate it together, it's an easier call to make, and just try to provide them with a solution or a partner to really give them the best information that they can make their decisions based on.
And we're over time, but I wanted to just ask Robert one question. Like a Mountain Lakes, is that seeing inventory building up and pressure on pricing? Because that's kind of a bellwether in Morris County.
So there was a house that came on in Mountain Lakes several months back, and it came on at $6.5 million. And it's down now to 4.9 million. So yeah, there is that same pressure. And what I wanted to mention with regard to what Dan was just talking about too, is that higher end marketplace really flourished during the pandemic with all of the people, the influx from New York City, with people who had a whole different set of what housing needed to cost, and really helped build that high end market again. But now that influx has diminished. As a matter of fact, there seems to be a movement back into the city, so that the high-end market is starting to really feel pressure in terms of pricing.
So that's like a double whammy, right?
Yeah.
So you're not only getting the inventory in, but you're having people. I have seen that. Go ahead.
So I used Robert's example of that home in Mountain Lakes. When it came on the market, I looked at it and go, whew, that thing is way overpriced, right? So how do you judge mispricing in this market or price reduction? Like if you misprice it wrong, you price reduce. I get it's a price reduction. I get it's a perception, but which it was wrong right from the start. So how do you weed through the nonsense, especially with so much adjusting? It's almost like a case by case.
So Glenn, what I would say is that you can't look at the individual transactions. You have to look at the overall behavior of the market, because there's always going to be overpriced homes. And, you know, if in that segment there's only one or two, that might tremendously skew our opinion of what housing is doing. But if you look at, you know, let's say a 3-month picture, and you look at, you know, 20 plus units, I think that if the market tends to overprice 3 of them, maybe even grossly overprice them, you're going to probably still see that same behavior by those same participants in the market. So looking at one would be, you know, problematic to draw a conclusion, but looking at, you know, a reasonable sample size, I think would give us a better indication. And I do know that the higher end is seeing a lot more significant pressure on pricing, and you know, the hypothesis as to why, I think Robert has a really good point. And did Otto comment on that or no?
Yeah, you know, absolutely. That was, you know, that was one of the things he touched on, because a lot of the analysis he does by price points. And where, you know, the last several seminars that I was a part of with him, it always showed that 2 million and above price point was really starting to show very positive signs, and now it's showing negative signs.
Yeah, it's showing weakness. I think, you know, I don't know if Scott Kaplan's still on, but you know, in his market, you know, a lot of out-of-state people or out-of-market people came in and bid the pricing up where it was unaffordable for, you know, the long-term the long-term community. And that similar thing has happened over in the higher price, where people are leaving, you know, multi-million-dollar, you know, condos and co-ops and coming to a different lifestyle in New Jersey. And I think, you know, Lori from, you know, our Rockaway office would tell me that people would move from Bergen County out to Morris County, and then inevitably she'd get a call like a month in saying, "Hey, Lori, how come all the restaurants are closed at 8 o'clock on a Friday or Saturday night?" And it's just a different culture. It's a different mindset. So
Yeah,
some people aren't
Rob,
going to be able to adjust to that. Go ahead.
Rob, yeah, on that point real quick, I know we're over on time. The same thing like you're seeing in the Hudson County market, right? Hoboken, Jersey City, you know, these places that just absolutely sold out. Vantage over there, right on the waterfront. My brother-in-law and sister-in-law live there. I had friends that live there. They pivoted during COVID, you know, when pricing went up, and bought a house in Ridgewood. They were looking Montclair, Ridgewood and everything, but that lifestyle has a huge, huge impact. Obviously, not to say, you know, it doesn't in the city, it's always been, but these communities like Hoboken and Jersey City, Weehawken, right along the water there, that is just killer. You know what I mean? You're locked in for 2 years and you can't do anything. And that's the lifestyle all those people are looking for. So that's, again, what contributed very, very dramatically to the, you know, influx in buys over here. Now that a lot of stuff's opening up again and restaurants are changing ownership and this and that, and they're trying to get the vibe the right way, it's starting to really, you know, come back in those areas. That's why we're seeing that shift again from our markets to the rental markets.
So we're way over. I want to wish everybody a happy weekend, and I pray that you have not had anybody, any family or friends, you know, impacted by that horrible storm. And if you can, you know, make a contribution or do something to help out our, you know, our community.